Let's talk about the most important skill I learned early on in my career, as it relates to business analysis, because there's a lot you can learn early on. It's the three-statement model framework and how cash moves through it. You have to understand how businesses create and consume cash. And there's no better way to do that than understanding how a three-statement model works. It is genuinely the best foundation for real analysis. A company with cash on the balance sheet and low debt has nothing but good options. And when times get tough, and they always do, those options go from good to great. At the core of it all is one simple truth. The only unforgivable sin in business is to run out of cash. And if you master the fundamentals that relate to this framework, you'll become ruthlessly effective at understanding this. So I'm going to show you how I teach this topic at asimplemodel.com, which started as a nerdy hobby born out of extreme frustration because I think people like to overcomplicate things. Once you're in the industry, you'll realize that finance is just arithmetic and vocabulary. It's simple. But understanding it thoroughly will give you an extreme edge, and this has been true throughout my career. I've worked in investment banking, I've worked in private equity, I was a founding member of a private equity firm, and I'm currently chief strategy officer of a large corporation. And I continue to use this framework to guide all of the most important decisions I work on. So let's dive into this overview. The objective of this curriculum is to get you up to speed as quickly as possible. It's focused on how every change on any financial statement impacts cash. And if you really understand this foundation, it makes all financial modeling much simpler. A leveraged buyout model, for example, is just a three-statement model adjusted to record a transaction. So I really think this truly creates the foundation for a terrific career. And each of the concepts, like the accounting equation, are really broken down into steps so that you can follow along. More exposure in different contexts helps cement abstract concepts. And that's what we really work on. For the accounting equation, I like starting here because it's a visual representation that assets are equal to liabilities and equity. Then we continue to iterate on visuals that dive into the vocabulary. I really think it helps to treat learning anything finance related like a second language. The more you revisit this vocabulary, the easier it will come to you. After a concept has been thoroughly explained, we start to demonstrate how it relates directly to the financial statements. By way of example, here you'll see that the balance sheet is just a formal presentation of the accounting equation. And this was something that was always difficult for me in other training materials. I wanted to understand the why. Why is it important that assets is equal to liabilities plus equity? And to answer that question, the videos on the website will highlight the importance of a balanced balance sheet. The content also introduces concepts like debits and credits, but not in the detail you would need for an accounting course. You need enough context to be dangerous, but it helps to have shortcuts to help you remember how all of this works. As an example, this slide introduces the DEALER acronym. Dividends, expenses, and assets are on the left-hand side and are equal to liabilities, equity, and revenue on the right-hand side. And between these two groups, you have the relationship beneath them clearly defined. And if you want more detail, a lot of the videos include PDF notes which run long and include a lot more examples. After that, the series introduces the expanded accounting equation. And I really find this framework extremely helpful. I actually had a hand-drawn version of this diagram in my cubicle the entire time I was an analyst. And in the content that follows, you'll understand why this is so important. And that's because the material really starts to accelerate at this point, and the accounting equation is helpful to all of it. It transitions to teaching you how to build a balance sheet for a startup. In this case, the banana stand, because I love Arrested Development. And there's always money in the banana stand. So while this is a jump and it may seem like a lot, the purpose is to demonstrate why these concepts are important early. Within one of the first videos, you're already seeing how a company builds cash on its balance sheet, and the relationships between the balance sheet and income statements start to come together. After that, we jump forward again to look at the simplest way to understand an acquisition. A lot of the content on asimplemodel.com is focused on private equity and how private equity professionals source, structure, and close transactions. So I wanted to provide this context early. And here again, you'll notice how the accounting equation is relevant. And finally, this video concludes with a demonstration of why financial models are so powerful. This example asks you to imagine that a company raises debt and then demonstrates that the amount of debt raised doesn't equal the amount of cash on the balance sheet. And it challenges you to figure out why. And by walking through the exercise and tracking down the movement of cash through this framework, you'll realize that the offset is the amount of interest expense paid in that period. And that's what's so fantastic about a well-built financial model. You can track how one change impacts the health of a business. And as you get deeper and deeper into this process, you can track how multiple changes will impact the future of a company, which is pretty cool. So the content does move fast, but important concepts are frequently revisited. And we introduce quick case studies for real examples. And before we dive into some of these case studies, I want to provide a few examples of concepts that get revisited. One is how the financial statements link together, which is absolutely critical. Another example is how working capital impacts financial statements. I find this to be wildly misunderstood, and I think it's so important to focus on because it's effectively capital allocation. Every time working capital is required to make a sale, you have to judge the quality of the associated revenue. And I'll explain a little bit of that momentarily. Another example is how companies build cash, because there's basically 3 ways to do it, which include equity issuance, debt issuance, and retained earnings. So that was largely an overview of the first video with some comments about how this content works. Next, I just want to provide a summary of how the content evolves from this point. As the content progresses, you'll be asked to visualize everything that a company needs to get off the ground, and we'll use that to build a visual balance sheet. I chose luxury sailboats as an example because I figured I'd never work at a company that makes luxury sailboats, but I like them. And once you've imagined everything you need to start the company, it explains how you raise the funds to secure those assets. And then the content really starts to emphasize how all of this comes together. The balance sheet shows you your financial position, and the income statement and the cash flow statement show you the economic activity that takes place in between balance sheets. And the difference between how economic activity is recorded on each of the 2 statements is also identified. To highlight these differences between the income statement and the cash flow statement, the video continues to introduce visuals to really help these concepts stick. In this visual, you're looking at how the matching principle helps an income statement answer this question for a company. Are you good at what you do? By matching revenue with expenses, you can determine the profit you're able to achieve by delivering a product or service. And that's a true measure of excellence for any company. Once you work through the income statement, a video on the cash flow statement picks up where the last video left off by demonstrating that the cash flow statement starts with net income, which is the last line on your income statement, and working towards cash flow for the period. As they say, cash is king, so this part's pretty important. As it progresses, the content gets more and more involved. Here we highlight the relationship between profit realized, the working capital required to generate sales, and cash flow for the period. And I think this is one of the most important relationships to understand within the 3-statement framework, and I think it gets constantly overlooked. You can create a lot of value within a business by really understanding these relationships. Basically, what it demonstrates is how poor working capital management or cash management ties up liquidity. Everyone should define what quality revenue looks like for a particular business. Another way to think about this is that not all revenue is created equal, and the relationships between all of these line items are explained in detail. The goal is not only to help you build a financial modeling skill set, but to help you develop a mental framework. If you can do this math in your head in meetings, it's really a fantastic advantage, one that served me extraordinarily well. And all of this content is heavily focused on how it relates to financial models. Again, in this video, I'm just covering the introduction to financial statements. But I think it's important to emphasize that the better you understand this, the easier it will be to build models and understand them. To apply some real-world scenarios to this foundation, we also start to explore some case studies. And Robinhood was an example I really liked. At one point, they got a lot of press because they were trading for less the amount of cash on their balance sheet. In the meme stock period, there was a lot of debate about what this meant. The content on the site asks you to imagine where this cash came from, because it had grown so substantially. It then uses lessons from previous videos to go back to the balance sheet. And in this particular case, it demonstrates that it's all due to equity issuance. Remember that there's 3 ways for a company to raise cash: equity issuance, debt issuance, and retained earnings. But in this case, the company didn't have any retained earnings. In fact, it had the opposite, an accumulated deficit. And what that means per the income statement is that the company wasn't currently good at what it was supposed to be doing. It wasn't generating any profit and consistently reported a loss. You can't consistently issue equity and debt without the promise of future profitability and cash flow. So the time you have available to get to that future desired state of positive cash flow is the amount of cash you have on your balance sheet divided by your burn rate. So the lesson here is this. If a company is trading for less than the amount of cash on its balance sheet, and you can't define the path to future profitability, you'll likely get burned on the investment unless you get lucky. And those are the lessons, case studies, and frameworks this first course introduces before you get to building a 3-statement model. After that, you'll work through the curriculum you see here, and you'll be well on your way to building what I think is one of the best skill sets to have in this industry. If you understand this backwards and forwards, everything else comes easy. All right, team. Thanks for watching. Be sure to check out the introduction to financial statements on asimplemodel.com if you found this interesting. Okay then, bye-bye now.